I do believe that it's possible for amateur investors that work hard to compete with professional investors. Professional investors often have a quarter by quarter focus, and the mining business doesn't operate on a quarterly basis. The fact that an individual investor can have an 18-month time frame competing with a professional who has a 90-day time frame immediately assigns an advantage to the amateur investor. And information is more broadly available now than it's ever been. Kitco to be sure, but other sources too. The truth is that I can get as much information online. And by the way, I'm a 67-year-old Luddite, not too competent online. But I can get as much information online in 3 hours as I used to be able to obtain through 6 or 7 weeks of trying to obtain printed information from, say, the Ontario Securities Commission or companies. What one really needs to do is limit one's exposure to stocks to a number concurrent with the number of hours per month that somebody is willing to work. If they're willing to work 10 hours a month, really work 10 hours a month, then 10 stocks is plenty, absolutely plenty. It's important too, David, I think, to understand that in the junior public stocks, there's probably 2,000 companies that at least purport to be in the mining or minerals exploration worldwide that are public. There's probably only 200 or 300 that have any value whatsoever. So the most important thing that you can do as a speculator looking at a stock that you don't own is find the really obvious reason not to own it, so that you don't have to waste any time on it whatsoever. Mm-hmm. If you understand that there are 300 real opportunities in a 2,000 company universe, the most important initial exercise that you can do is the screening exercise, which throws companies away so that you don't have to waste time on them. Yeah. People are afraid of missing opportunity when they should be afraid of accepting risk. As I can briefly, but I would suggest at a later date that we delve into this extensively, because This is an hour-long discussion.
Sure.
What I have found with regards to junior resource stocks in particular is that the most important factor is people. There are some management teams and some individuals that have been serially successful, and many more that have been serial failures. But in bull markets, the investors don't seem to segregate between the born losers and the born winners. And hanging out with the born winners is really the first thing you do. In fact, David, looking back at my own career over 45 years, focusing on my mistakes rather than other people's mistakes, had I merely concentrated on the 10 or 15 management teams that I had had the best success with up to the age 35, I'm 67 now, so that's 30-something years ago, I would have done half as much work and made twice as much money if I do it. If you think about buying other kinds of goods, like say your suit, if you went to a store and saw that suit selling for twice the price that you had paid for it 6 months ago, you'd be furious. If you went to buy it and saw it selling for half the price, you would be delighted. But people aren't as smart when they buy stocks as when they buy suits. Mm-hmm. So it's important to buy these things when they're out of favor, when they're on scale.
Yeah.
The third thing I would suggest is that scale is important. If you're going to take risk, don't take risk for small rewards. In gold equivalent terms, if the target size or the target or the resource, whatever the number is, doesn't exceed 1 million gold equivalent ounces, which is to say there isn't sort of 1.8 billion in situ value. Where I don't believe that the deposit could be produced at 100,000 ounces a year or more, which is to say $180 million in gross revenues a year or more, I don't care. There is as much risk in a small mine as a big mine, but a small mine can never make you big money. And the idea of negative asynchrony, which is to say taking big risks for small money, is not attractive. Taking big risks for big money is somewhat more attractive. So I would say, look at those things. Also, adjust your time preference to the task at hand. If you buy a small speculative stock because you believe that the drilling campaign that's underway will change the market's understanding of the deposit and hence increase the value of your shareholdings, understand how long it will take for that drill campaign to add value.